I'm often asked, is my accounts receivable balance too high? Well, I don't know you. I've never seen your balance, so it's really hard for me to answer that question for you. But here are 3 signs to help you answer the question yourself. Because for some companies, $1,000 is too high. For others, they can tolerate up to $1 million in an accounts receivable balance. So it's really dependent on your business, your tolerance level, and your cash flow. But here are 3 signs to help you determine for yourself if your balance is too high. The first one is you have a hard time paying your bills on time. This may sound like common sense, I may even sound like Captain Obvious, but it's very, very common when business owners see that they don't have enough cash in the bank to pay their bills on time. Their first response is, "Ooh, I need to increase my sales. Ooh, what do I need to do to increase my marketing budget?" When I'd really like to encourage you just to take a step back, look at your accounts receivable report and see who owes you money. Because until you finish that transaction of the sales that you provided last week or last month or even 60 days ago, you need to really focus in on collecting the cash from the sales that you provided before. Remember, a sale is not a sale until you get paid. Until you get cash in the bank, the sale doesn't even count. So instead of thinking about increasing your sales, let's figure out how to get paid for all the sales that you've already completed. So definitely take a look at your accounts receivable report and see if there is cash hiding in there. The second sign that your balance might be too high is the balance continues to increase. Keep in mind that the accounts receivable balance is directly tied to your sales account. So as your sales increase, it's very common for your accounts receivable balance to increase. And that's very common in your busy season. But when you start to slow down, when you start to go into your slower season and sales start to decline, you should see the same decline to start in your accounts receivable balance. If that balance continues to increase while sales are decreasing, that's a sign that you've got a problem. It might be too high and you might need to invest some time in it. The third sign that your balance is too high is when you look at your accounts receivable report from your accounting system and it doesn't look healthy. So an unhealthy report has too much of the balance is tied up with one customer. So for example, if you have a $100,000 accounts receivable balance, but one customer makes up 25% of that, or $25,000, that's a sign of an unhealthy report and the balance might be too high. Because if that one customer doesn't pay, that might hurt your ability to pay your bills 30 days from now, depending on when that money is due. Another sign that your balance is unhealthy is 50% of your accounts receivable report or the balance is past due. So of that $100,000, if $50,000 or more is past due, where your customers haven't paid you for more than 30 days, especially 60 days, the longer it gets, the less likely you'll actually collect that money. So when you're thinking about your accounts receivable balance, I want you to think about these 3 signs. First, can you pay your bills on time? Second, does the balance continue to increase? And then third, do you have an unhealthy report? If you are struggling with any one of those, then yes, your accounts receivable balance is probably too high. If you are concerned about it, you need to trust your gut, dive in a little bit deeper and research it. And if you'd like to see what a healthy accounts receivable report looks like, I encourage you to watch the next video because I will show you examples from QuickBooks that you can actually use in your business. Thank you so much for watching.